the situation that we have time for, and that might be the most widely held, most interesting stocks to the most people. One we're going to focus on is Occidental Petroleum, symbol OXY, Oxy. Again, as I mentioned before, we have this top up here, and we're going to take a picture of this and to talk about it a little bit as to how we might trade this situation if we had it available to us to trade. Okay. Looks like we have to wait for the thing to do its work here. Okay. What we're talking about with Oxy is a market that has moved up. I mentioned we experienced the lows way back, like every other stock. When you go back and look at the lows in March and the things that happened to the whole stock market in general, you don't want to fight the stock market when you're talking about any individual stock or sector. It's the big picture that you have to be concerned about. So I'm not saying we are treating any stock in isolation, but keeping the whole big picture in mind, we have to kind of keep an eye on what's going on elsewhere. It's not just a unilateral decision that we're going to be making here in any particular stock. First of all, the one we're going to look at in Oxy is, I want to point out again, we have this high, and it's approximately in the vicinity, I probably made that line a little bit too low, but it's in approximately the vicinity of 85. On the bottom side, we have a range that's pretty much been established. And we're talking about what we're talking about here, and that is at 75. Now, what happens? How do you trade this market? As I mentioned, you can trade it as a breakout situation. There's another way that you can trade this, and you can trade this with calls, with options, depending upon your versatility and your knowledge of options and whether you're willing to get into that particular type of a market. The options provide some good opportunities to kind of trade a range like this, as long as the range is going relatively smooth up and down and giving you some opportunities to get in. First, you do need to establish that you are in a trending type situation. Then you have situations where the market is topping, and then it comes down. It tends to hit the bottom of the range, top of the range, so it kind of works within the range. You'll note where we're at today. We are at the bottom of the range, and if you were playing some of the odds and looking at it from a perspective of an options trader, you would think that this might be a possible spot in which you might want to do something. Typically, when traders are looking at stocks, they're buyers. So when it's at the bottom of the range, you have several choices. You can buy the stock itself, you can buy a call, or you can sell a put. Any one of those three. When you're at the top of the range, obviously you have the same kind of alternatives. You can sell a stock, you can buy a put, or sell a call. Generally, I would say probably in most cases, people are not really that comfortable at least, with selling stocks, selling shares. There's some involvements there that are more complicated, so it may not be something that you like to do, but it is possible to do that in options fairly easily. Now, if you're looking at the situation today, I looked at some prices today, and I think the price of Oxy was around 76.80 in the 77 area, something like that. So if you were in a situation where you said, okay, I'm at the bottom here, and I have a choice. I could either buy a call, or I could sell a put. Which would I want to do? That you're assuming that the price is going to go up. You assume that if you buy a call, you want the response to be enough to cover get above the strike price enough that you can make some money on it. In this case, we're looking at the 75 call. As I mentioned, the 75 call today, if you were to buy that, you could buy it at 165. That means that the market has to go up. The price when I did this was around 77, so you can see that the price is going to have to move up somewhat from 75 where it is at today. If you were to look out a little further, let's say you were to have a choice of maybe you'd prefer to sell a put, because the assumption here is that, yes, the prices have gone down, but we're at the bottom of the range, and they're not going to go down that much further. So I think they will not go below 75 or whatever criteria you happen to set. I mean, you don't have to sell on 75, but I'm using that as the bottom of the range at which you might want to sell a put. if you were to sell today, and again, when you are in that situation where you're trying to, take advantage of the decay in time and so forth, you want to try to make, if as a seller, you want to have the February 75 call. I believe the price here was 340. I'm not, whoops, I made a mistake here. That's 165 is what, or 155 rather, to get the correct price at which you could sell. Then you assume that after the market kind of does its thing, and if it goes back, stays within the range, you can collect the premium when that February contract expires in about 20 days, 25 days, something like that. Maybe that's a little closer and you're looking a little bit ahead a little bit. You can do the same kind of thing. Maybe you want to move ahead to the March contracts, the March options. If you were in a situation there where you had the March 75 put, you could sell it for $295. When you look at what is happening on the chart or in the options ladders and compare the puts and the calls and who's doing what, it appears that the crowd is obviously more bearish on the oil stocks at this particular moment, this particular day. So then you have a choice to determine, is the crowd right? Are they, clicking because the crowd always tends to be wrong. Do with selling puts because the amount of money you have to put up is larger than what you would have to do with a buy situation. You could buy the March 75 call. You'd have to pay $4.70 for that. So again, from that point, you'd have to say that the price of Oxy is going to have to climb above 80 to make sure that you're going to be able to get any profit out of that particular trade. And whether your conviction is that it will or it won't could determine on whether you will buy that call or if you'll sell put. You can also, if you prefer, go further out and you can take a look at the January 2011 situation, because when you look at January 2011, that's a whole year away. It has a lot of time to act. Let's say that you feel that the market just isn't going to go down. You just want to put it that way. It's not, you don't know if it's going to go up, but you just don't think it's going to go down that much further. You could then do the 80 put, sell the 80 put at 1230. Again, when you sell, that's going to put a lot more risk on you because you have to, if the